Andrew, so lovely to have you at the desk this morning and looking at the market performance. Around 53,000 is where we are. First new day of the month. Let's maybe take back and take a look at some of the key trends that have played out and what we can expect.
Yeah, I think, well, it's difficult to try and predict what's going to happen going forward. But if we look over the last month or even year to date, we've seen a reverse of the trend that we saw over last year, where we saw industrials sitting up really nicely last year. And I think, in our view, probably sentiment was in the wrong place. If you look at what earnings have done within industrials over the last year, they've actually gone backwards, whereas you've seen that huge price increase, or essentially industrials have been driving the market. This year we've seen that turn around now. We've seen resources sitting up really nicely. I think they're up about 28% year to date, where industrials and financials have been flat. So, you know, this has played into, we've been singing this song for a long time. We said resources are cheap, industrials have been expensive. So long may that last, this trend. But going forward, I think you've really got to look at, you know, at the end of the day, what drives markets, and that's earnings, fundamentals. And if you look at, you know, where the valuation or market valuations sit at the moment, we think opportunities reside within financials and banks in particular. They've been priced or derated significantly on the back of concerns around what's going to happen with South Africa's sovereign credit rating in the near future or later this year. And industrials, we've seen the earnings come off, but they remain on these elevated multiples. So we think the risk lies in investing in these half-line or very well-loved industrial companies.
What about the resources? I know that you said they are cheap. And do you not think that maybe this might be a time to start nibbling at the resources at the moment?
Well, look, the resources, as I said, they've run quite hard already this year. So I think if you weren't in it towards the end of last year, you've probably missed the early start of that run. That's not to say they can't run more. And we look at, even if you just look at precious metals, gold and platinum, you see these shares are up 100%, 200%, some of them, even more. And that's on the back of a gold price that's increased 20% this year. You know, nothing's going to stop the gold price going higher. And if that does happen, you'll see these precious metal counters continue to go up. We've seen commodity prices in general starting to recover. We've seen what iron ore's done over the year. So if there's stability around these commodity prices, I think there's definite opportunity within the resource shares at the moment, specifically the diversified miners, the likes of Glencore, that is probably more with their trading business, slightly more defensive than some of the other miners.
Andrew, as a Chief Investment Officer, I mean, you obviously watch a lot of economic data that comes out to help you strategize. So on Friday, we've got that all-important non-farm payroll numbers. Is it still very much important? And what will you be looking out for?
Yeah, I think without a doubt, it is important just to try and get a sense of what's happening in the US economy. I think we've seen it slowly improving over time, and I think yesterday they came out with some manufacturing data that improved slightly. We saw markets increase on the back of that in the US, but obviously the big news item comes out, I think, on Friday, the non-farm payrolls. We expect to see that increase. Indications are that they will go up this week, which gives you insight into what the Fed's thinking in terms of interest rate hikes, or not if, when they're going to continue to hike. So yes, that's obviously a very important indicator, and I think markets will be fairly sensitive leading up to that data coming out.
Let's come closer to home, looking at the SENS announcements this morning. Tiger Brands, they came out with a trading update. It's doing a market update earlier on, and it was down about 2%. So they do talk about costs push pressures. I'm not sure how you are reading this particular company. We all know about the Nigeria story.
Yeah, they've had a very...
Behind that. Is that behind us now?
I think it is behind us because they've sold that business. So that business, I think, end of Feb was sold. So that is, yeah, in the past. There definitely are cost pressures. The weaker rand hurts them, and obviously then there's the drought, which has also hurt their costs. There's new management coming in, and Tiger Brands, as I said, they've been through a very difficult patch over the last few years. Obviously, the main issue being in Nigeria. It trades on a PE multiple of 19 to 20 times, which is quite demanding given where the company's been over the past few years. So I think the new management comes in, I think, this month or in the next week or two. So I think they will need time to bed down the operations. If you looked at continuing operations, the headline earnings is expected to be flat, so it wasn't a great number, so it's not surprising to see the market price it down. But I think we need to give the new management team some time to bed down operations, get their feet under the desk and see what they can do. Given what it's doing or what the business has done recently, I don't think it deserves a PE of 20 times. I think that's slightly demanding, so I would be sitting on the sidelines on this one for the time being. On
the sidelines there. What about Rhodes Food Group? They came out with a trading update too, and also they're in that same, they're playing in that same space.
Yeah, they're obviously in the food sector, but they're a slightly different business. I think they're focused on frozen foods, fresh products, long-life products, so they don't compete directly with the likes of a Tiger Brands or an AVL or Pioneer, so they're in a slightly different market, if you can call it that. They listed, I think, 18 months ago. There's been a lot of corporate activity within this business, so it's quite difficult to try and get a sense of the valuation. If you just look at naive multiples that I alluded to earlier, it looks very expensive. But then if you look at their trading update, I think the headline earnings are expected to be up, I can't remember the number, 80 or 90%.
85 to 90%, yeah.
Exactly, and that's all the corporate action. They exposed to Southern African markets, which I think are the right African markets to be exposed to at this time, as opposed to West Africa. So they've got very nice exposure there. They appear to be doing the right things. So time will tell with this one. It's priced for growth. So far, it looks like it's delivering that growth.
Okay.
It's going to need to continue to do that.
All right, so Tiger Brands, wait on the sidelines a little bit, and with Rhodes, it looks as though they are maybe priced for growth. Thank you so much, Andrew.
Great,
Very big thank you to Andrew Dittberner. He's the Chief Investment Officer at Cannon Asset Managers.